Something unusual is happening in the metals market right now, and most people are not looking at the right place. While headlines keep focusing on stock indices, near record highs, and inflation numbers that appear to be stabilizing, another signal is flashing quietly in the background. Silver is moving in a way that does not fit the story of a calm and stable global economy. When I look at the data, and when I compare it to patterns I have studied for years, I see the same kind of early tremors that have appeared before major financial shifts. If you watch the price movements closely, you begin to notice the fractures. Silver is not just rising, it is swinging violently, sometimes 10% in a matter of days. Physical inventories in some exchanges are tightening, even as paper trading volumes expand to extreme ratios. The gold-silver ratio, which spent long periods elevated in the past decade, has been compressing. These are not random market fluctuations. Historically, these kinds of signals have appeared during periods when liquidity, conditions, currency confidence, or supply chains were under strain. I saw similar distortions forming in commodities in the early 2000s before the credit boom peaked, and again in certain metals in the years leading up to the 2008 financial crisis, when funding markets looked stable on the surface but were already beginning to crack underneath. The real reasons behind these movements are structural, not temporary. Governments across the world are carrying debt levels that would have been unimaginable a generation ago. Servicing that debt requires low real interest rates over time, which gradually erodes the purchasing power of currencies. At the same time, the global economy is undergoing a transformation. Energy systems, digital infrastructure, electrification. And silver sits at the intersection of all of these trends because of its industrial role. Unlike gold, which primarily reflects monetary stress, silver reflects both monetary conditions and real economic demand. That dual nature makes it extremely sensitive, almost like a seismograph recording pressure building deep below the surface. And this is not an isolated observation. Central banks continue accumulating gold at a pace not seen in decades. Sovereign debt ratios remain historically high, and global liquidity, despite tightening cycles, remains elevated compared with pre-2020 levels. When multiple institutions, governments, and markets begin positioning in ways that suggest caution about long-term currency stability, it becomes clear that the signal is broader than any single commodity. Silver is simply reacting faster than most other assets. Yet, here is the contradiction that makes this moment so difficult to interpret. Equity markets remain resilient. Corporate earnings in major economies are still holding up, and inflation, at least in headline terms, has moderated from its peaks. To many observers, this looks like a controlled landing, a system stabilizing after a shock. But markets often behave this way before turning points. The late stages of expansion frequently appear calm because liquidity is still present, and confidence is not yet broken. The warning signs rarely appear in the most visible indicators. They appear in the margins, in funding costs, in commodity spreads, and in the behavior of assets like silver that respond quickly to shifts in both industrial demand and monetary expectations. So, when you look at silver today, I want you to understand what you are really seeing. You are not just watching a volatile metal. You are watching a market that is responding to pressures building across the global financial system. Pressures from debt, from currency dynamics, from geopolitical fragmentation, and from the structural changes reshaping the real economy. And if history has taught us anything, it is that these early signals are often dismissed, ignored, or misunderstood, until suddenly they are impossible to ignore. Right now, I want you to step back with me for a moment and look at the wider picture, because what is happening in silver cannot be understood in isolation. You are living through a period where the global financial system appears calm on the surface. Yet underneath that surface, the forces shaping markets are becoming more powerful and more unstable at the same time. I have watched cycles like this for many years, and what makes this period unusual is not just the price levels of metals or equities, but the combination of signals that normally do not occur together. Look at the environment around you. Equity markets remain elevated, in some cases near historical highs, driven largely by technology sectors and liquidity that never fully left the system after the pandemic-era expansion. Inflation, which once surged into dangerous territory, has moderated in official statistics, creating the impression that central banks have regained control. Bond yields have stabilized rather than continuing their relentless climb, and volatility indices show caution, but not panic. To many observers, this looks like stability returning. But I want you to understand something very important. Stability in financial systems is often an illusion that exists just before large adjustments. When I look at the macroeconomic structure today, I see debt levels across advanced economies exceeding thresholds that in previous decades would have been considered unsustainable. Governments are financing deficits that would once have triggered immediate currency crises, yet the system continues functioning because liquidity remains abundant and because markets still believe central banks can manage the outcome. But history tells us that debt cycles do not end quietly. In the late 1960s and early 1970s, the Bretton Woods system began to fracture under the pressure of fiscal expansion and currency imbalances. At that time, most people did not notice the warning signs until convertibility was suspended, and the monetary order changed almost overnight. Now, look at the monetary environment you are standing in today. Real interest rates remain relatively low compared with historical periods of high debt. Money supply growth, even after tightening cycles, is still significantly higher than long-term averages. Central banks in different regions are moving in different directions, creating divergence in currencies and capital flows. These divergences create stress points in global funding markets, and those stress points often appear first in commodities and currency-sensitive assets before they reach equities or credit markets. At the same time, geopolitical risks are no longer isolated events. They are persistent conditions. Trade fragmentation, sanctions regimes, resource nationalism, and strategic competition are reshaping supply chains. When countries begin restricting exports of key materials or accumulating reserves of strategic commodities, it changes pricing structures in ways that traditional financial models struggle to capture. Silver, because of its industrial importance and relatively small market size compared to gold, reacts quickly to these shifts. It becomes more volatile, more sensitive, more unpredictable, and that volatility is not random, it is information. And here is where the contradiction becomes even sharper. You are seeing strong consumer spending in some regions, corporate earnings that remain resilient, and unemployment rates that are still historically low in several major economies. These are not the signals people associate with approaching stress. But financial history shows again and again that turning points rarely begin with obvious distress. In 2007, credit spreads were still relatively contained, and equity markets were still climbing. In early 2020, global growth indicators had not yet collapsed before liquidity suddenly vanished in key funding markets. Systems do not always break slowly. Sometimes they hold together until the pressure reaches a threshold, and then the adjustment happens rapidly. So, when you look at the current market environment, I want you to see both realities at the same time. Yes, there is resilience. Yes, there is liquidity. Yes, there is still growth in parts of the world. But there is also unprecedented debt, structural inflation pressures, geopolitical fragmentation, and a monetary system that has been stretched further than at any point in modern history. Silver is not creating these conditions. It is reflecting them. It is reacting to the tension between a system that must continue expanding and a reality where resources, currencies, and confidence cannot expand indefinitely. And this is why I speak to you with urgency. Not because a collapse is imminent or because panic is justified, but because the signals forming today are the kinds of signals that, in hindsight, always seem obvious. The difficulty is recognizing them in real time. While the system still appears stable, while headlines still focus on growth and recovery, and while most people are still convinced that the future will look very much like the recent past, I want you to focus with me now on the deeper forces driving what we are seeing, because price alone never tells the full story. When a market begins to move in extreme ways, the real explanation is almost always structural, and that is exactly what is unfolding here. Silver is not rising or swinging violently because of a single news event or a temporary wave of speculation. What you are witnessing is the collision of long-term economic forces that have been building quietly for years. First, look at demand, not from investors, but from the real economy. You are living through a technological and industrial transition unlike anything since the electrification waves of the early 20th century. Solar panels, electric vehicles, advanced semiconductors, high-efficiency batteries, and modern grid infrastructure all require silver in ways that older industrial cycles never did. Industrial demand is not a short-term trend, it is structural. Once a society commits to electrification and digital infrastructure, consumption becomes persistent, not cyclical. That is one side of the pressure. Now, look at the other side. Supply. Silver production does not respond quickly to price because most silver is mined as a byproduct of other metals such as copper, lead, and zinc. That means supply is tied to the economics of entirely different industries. Even if silver prices rise sharply, new production cannot appear overnight. This is a classic inelastic supply structure, and when inelastic supply meets steadily rising demand, volatility becomes inevitable. I have seen this dynamic before in oil markets in the early 2000s and in certain rare earth markets more recently. The pattern is always the same. Tightness builds quietly, inventories begin to decline, and price movements become increasingly violent as the buffer disappears. But there is another layer, and this layer is financial rather than industrial. The silver market, like many commodity markets, operates with a large derivative structure built on top of a much smaller physical base. Futures contracts, options, and other paper instruments create liquidity and allow hedging, but they also create leverage. When the ratio between paper claims and physical supply grows too large, small disruptions can produce outsized price reactions. This is not a theory. It is something markets have experienced repeatedly. The London gold pool collapse in 1968, the Hunt Brothers silver episode in 1980, and even certain episodes in the nickel market in recent years all demonstrated how quickly pricing mechanisms can become unstable when physical constraints collide with leveraged positions. I want you to understand what this means in practical terms. It means that silver behaves differently from most financial assets. It can move with the economy during periods of growth because of its industrial role, and at the same time, it can react to monetary stress, like a precious metal. That dual sensitivity is rare. It makes silver more volatile, but it also makes it more informative. It reflects multiple layers of reality at once: industrial demand, monetary policy, currency dynamics, and investor psychology. Now, consider the global monetary backdrop surrounding this. Money supply expansions over the past decade, especially after the pandemic, pushed liquidity into every corner of the financial system. Even after tightening cycles, balance sheets remain far larger than they were in previous decades. Debt levels across sovereigns, corporations, and households have reached levels that make prolonged high real interest rates extremely difficult to sustain. When a system reaches that point, markets begin to anticipate future monetary accommodation long before it happens. Commodities, particularly those with limited supply, often react early to that expectation. And then there is the geopolitical dimension, which you cannot ignore. Trade routes are being reshaped, strategic resources are being classified as national security priorities, and export restrictions are appearing in sectors that once operated under relatively open global trade. When countries begin to compete for resources rather than freely exchange them, pricing structures change. Physical premiums begin to diverge from paper benchmarks. Regional markets stop behaving in perfect synchronization. These are subtle signals, but they are powerful indicators of a world moving away from the fully integrated financial and trade system that dominated the last 30 years. What makes this moment so important, and I say this from years of watching markets evolve, is not any single data point. It is the convergence, industrial transformation, constrained supply, leveraged financial structures, high global debt, persistent liquidity, and geopolitical fragmentation are all occurring at the same time. Each of these forces alone would be manageable. Together, they create a system that becomes increasingly sensitive to shocks. And this is why silver's behavior matters, not because it predicts the future with certainty, but because it reacts quickly when pressure builds in multiple parts of the system at once. It becomes a kind of early indicator, a reflection of stress forming in layers that are not yet visible in headline economic data. When you see that kind of movement, you are not just watching a commodity. You are watching the underlying mechanics of the global economy adjusting in real time, often before most people realize that the adjustment has even begun. Now, I want you to think about what all of this means going forward, because this is the part where most people become uncomfortable. It is easy to describe what has already happened. It is much harder to face what the signals may be pointing toward. And I am speaking to you directly, as someone who has watched multiple cycles unfold, because the pattern forming today has appeared before, in different forms, in different decades. Always dismissed at first, always underestimated. When a financial system carries extreme debt, when real interest rates struggle to remain positive, when currencies begin to weaken gradually rather than collapse suddenly, and when commodities tied to both industry and money begin to behave erratically, history shows that the system is entering a transition phase. Not necessarily a collapse, not necessarily a crisis tomorrow, but a shift. These shifts are slow at first. They happen quietly, almost invisibly, while headlines still talk about growth and stability. Then over time, they accelerate. You have seen this before, even if you did not recognize it at the time. In the late 1960s, few people believed the Bretton Woods system would end. The dollar was considered stable, global trade was expanding, and most investors assumed the system would continue indefinitely. Yet, pressure was building beneath the surface. Fiscal deficits, gold outflows, and growing imbalances. When the break finally came in 1971, it felt sudden, but in reality, the signals had been there for years. The same thing happened in different form before the 2008 financial crisis. Credit markets were sending warnings long before the stock market reacted. Funding stresses appeared in obscure corners of the system, in instruments most people had never heard of. By the time the crisis became visible to the public, the adjustment was already underway. Financial systems rarely send their warnings through the most visible channels. They whisper first, and only later do they shout. Right now, the global economy is full of those whispers. Sovereign debt burdens are historically high. Fiscal deficits remain persistent even in periods of economic expansion, something that used to occur only in recessions. Central banks are walking a narrow path, trying to contain inflation without destabilizing debt markets. At the same time, geopolitical fragmentation is reshaping trade flows, supply chains, and capital movements in ways that reduce efficiency and increase long-term costs. And here's the contradiction that I want you to understand clearly. Markets can remain resilient for long periods, even while structural risks are growing. Liquidity can keep asset prices elevated. Technology-driven productivity can sustain corporate earnings. Consumers can continue spending, supported by employment and credit. All of this can happen at the same time that the underlying financial architecture becomes more fragile. Stability and fragility are not opposites in the short term. They often exist together. This is why signals from markets like silver matter, not because they guarantee any specific outcome, and not because they tell us exactly when something will change, but because they reflect stress in real time. When physical inventories tighten while paper claims expand, when volatility rises while broader markets remain calm, when a commodity tied to both industry and money begins to behave in unusual ways, it is telling you that pressures are building somewhere in the system. I am not telling you that a crisis is imminent. Markets do not move on our schedules, and history never repeats in exactly the same way. But I am telling you that ignoring early signals has always been the most common mistake in financial history. The people who studied the indicators, who paid attention to the small anomalies, who listened to the whispers before the noise began, were the ones who understood what was happening, while others were still surprised. So, as you look at the world around you, at rising debt, shifting currencies, geopolitical tensions, and commodities behaving in ways that do not match the narrative of stability, I want you to see the larger picture. You are living in a period of transition, whether it becomes dramatic or gradual. Systems that were built in one era are being tested by the realities of another, and markets, especially sensitive ones like silver, often reveal those tensions long before they appear in official reports or headline statistics. What matters now is awareness, not fear, not speculation, not reaction, but awareness. Because every major shift in financial history began the same way, with signals that most people ignored, movements that seemed confusing at first, and a handful of observers who realized that something deeper was changing beneath the surface, even while the world above still looked calm.